The volcano is one of nature's most destructive forces. They erupt every so often, bringing fire and destruction to mankind. Some supervolcanoes can even bring extinction events. In order to predict when the next eruption will occur, geologists will study their eruption history and form a pattern. We can also do the same with the stock market. We can study the market's past crashes and see if we can form any pattern. With this idea in mind, we can try to predict the next stock market crash and hopefully protect our investments from it. Here are 4 top essential stock market crash facts that investors must know. In March 2020, the stock market crashed. The unprecedented uncertainty created by the pandemic caused the benchmark S&P 500 to lose 34% of its value in only 33 calendar days. For contrast, it's taken an average of 11 months for previous bear markets to reach a similar decline of at least 30%. So you can see how fast and furious the March crash was. In addition to one of the most brutal stock market crash in history, investors also witnessed a ferocious rally from the March lows. It took less than 5 months for the S&P 500 to hit a new all-time high from the bear market low. This rally was also a record. With the endemic far from gone, the question has been raised if this roller coaster ride could continue. History would certainly seem to suggest that additional volatility with even another stock market crash is possible. In the event of another stock market crash or correction, here are the top 4 essential stock market crash facts to remember. Number 4, 10% correction every 1.84 years. Before I continue, I like to give credits to Sean Williams because I will be referencing his research. One of the most critical things to understand about stock market crashes and correction is how often they occur. Stock market has been referred to be one of the greatest wealth creator on earth, and we should all take advantage of it. If you wish to use the stock market to create wealth, you of course have to pay the price as well. The price comes in the form of periodic pullback in stock prices. There is no free lunch in this world. A technical stock market correction is defined as a 10% fall from recent closing highs. Since 1950, the S&P 500 has seen 38 technical stock market corrections. This translates to a correction of at least 10% every 1.84 years on average. And this brings us to the very next important fact. Fact number 3, a bear market every 7.78 years. 9 of the 38 corrections resulted in an official bear market with a loss of 20% or more. On average, a bear market happens every 7.78 years. As much as we prefer the stock market to keep going up, the economic cycle has natural peaks and troughs. These troughs are the ones that cause equity values to fall, and we need to be aware of their behavior. The stock market can fluctuate independent of the underlying economic situation. While long-term stock movements are driven by the company's profitability, news events and investors' emotion usually dominate in the short term. Emotional trading has a tendency to overshoot both up and down, which is why stock market corrections and crashes may be so severe at times. Number 2, average crash and correction lasts 6 months. Investors should be aware how long stock market crashes are and how long corrections last. The truth is that most corrections and crashes last months. This is in contrast to bull market. Bull market can last several years. Over the last 70 years, more than 2/3 of all corrections run their course and reach a bottom in a short period of 3.5 months or less. Another 18% of correction and crashes have recovered between 5 to 10 months. To put it in another way, historically, more than 4 out of 5 stock market corrections and crashes have reached bottom in 10 months or less. 10 months can seem like a long time. Compare this to the fact that stock market has recently completed an 11-year bull run. Recently, from the mid to late 1980s, there has been a shortening of correction duration. Thanks to the advancement of information technology, it's gotten easier to broadcast information to regular investors. Due to this, false information is less likely to spread. As a result, 13 of the 16 corrections since 1985 only lasted 6.5 months or lesser. Since 1950, the average correction has lasted about 6 months. And if we go further forward in time, since 1985, corrections last shorter. It has shortened to 5 months. Number 1. Favorable long-term odds. Perhaps the most important stock market crash statistics of all is that every official downturn in the S&P 500's history has eventually been erased by a bull market rebound. To be honest, there's a lot we don't understand about stock market corrections and collapse. We will never be able to predict the future. We will never know when the correction will happen, or how long it will last, or how fast the decline will be. But what we do know is that every single time a correction or bear market that occurred throughout history, it has been followed by a bull market rise. Sometimes this might happen in a matter of weeks or months, while other times it can take years to recover the losses. The idea is that if your investment horizon is defined in years, no correction or crashes should be a major issue. In fact, every single crisis or correction provides a great purchasing opportunity for long-term buy and hold investors. The stock market's average yearly return, including all those crashes and corrections, has historically been approximately 6 to 12%. This indicates that long-term investors may expect to double their money once every 10 years on average. In summary, the top 4 statistics are as follows. Number 4. The market experienced 10% correction every 1.84 years. Number 3. A bear market occurs every 7.78 years. Number 2. The average crash and correction lasts 6 months. And number 1. There is favorable long-term odds of investing into the stock market. Agree or disagree with the video? Subscribe, leave a like and comment down below, and I'll see you in the next video.